Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for July 20th, 2023, Market Insights and Observations. Our three key topics today, essentially just a broad overview, a macro look at the economy, where we are. And I'll just be brief on this one today because we're going to send out an invitation in a little bit in the next week or so about our second half Market Insights and Observations webinar. So we'll go through in a greater detail different sectors, different opportunities, different portfolio positioning as we're going through our client reviews and rebalancing. Again, if you're a client and you would like a sort of a check-in and a review, please reach out to us, as well as like, subscribe, and share this video with friends and family. We're happy to help. But so historically, let's start off with Milton Friedman. And he was basically one of the greatest economists of all time, who basically talked about the world that we know in many decades ago. He talked about the money supply. And as we know, the M2 money supply is what we pay attention to. That's what a lot of Wall Street and economists pay attention to. And essentially, as I want to interpret it or talk about it, it's like the oxygen in the economy. Remember, we have all the stimulus that we saw that was injected into our economy by way of the COVID stimulus relief, so on and so forth. Well, I think we're getting to the sort of tail end of all of those dollars sort of working their way through the economy. That's why we saw such great inflationary pressures. Started with goods when we couldn't go out and spend that money. So the hard fixed costs, think about the Peloton bike. Everyone said, oh, this can be a great idea. And then that money and additional capital that was sort of doled out to the economy, both on the consumer as well as the government, are working their way through to services. Now, this is the summer of travel. Everyone that we know is traveling, not only here but abroad. And so all the travel sector stocks related, so on and so forth, are actually have upside surprise, and it shouldn't be a surprise to anybody because that's the natural progression of how this M2 money supply by Milton Friedman is working its way through the economy. The real economy first, and then inflation and rates are about a year later. That's to be expected. Next week, what the market's paying attention to, two things: the Federal Reserve, and they want the economic information to come sort of continue their way, which is inflationary pressures are coming down. They want to see wages come down as well as rents come down. Those are sort of the last two hanging, sort of holding on, that give the Federal Reserve the cover to continue to raise interest rates, or at least keep them where they are. We believe that the Federal Reserve is going to raise one more time next week. If you look at Wall Street Fed Funds futures, there's about 85% chance that they will increase next week. And again, like we said in the two-day meeting, it's always the post sort of raise announcement press conference of what Jerome Powell says, and that could be moving markets. And markets have been anticipating sort of in the last, sort of 9 sessions, we saw markets go up. Sort of a couple of weeks before the Federal Reserve's announcements. Markets usually do that. They try to anticipate or over sort of position, and we're seeing that in a positive way, meaning and signaling that the Federal Reserve may just take a pause after this next week. And so it's a wait and see environment. Also next week, what's key is to see what the M2 money supply, again, that's with sort of all the money that's built up into the banks, and is it coming down in terms of all the savings for the consumer specifically. 2/3 of the U.S. economy by way of the GDP is what the consumer, what you and I spend money on. So as hopefully inflationary pressures come down at the pump, energy wise, or even groceries, if you will. I think the travel has been we need to see that come down too as well. How we position for the next second half of this year? Well, there's going to be some sort of give and effect, a yin and a yang that we see. So globally, we're still watching China because China is slowing. So if China does throw on some stimulus, that has a positive impact to not only U.S. markets, but global markets. And there's some historical data to support that. China has sort of outright in the last 48 hours said that they're not going to stimulate their economy, and there's sort of a slow reopening process. So it's a wait and see. So that's sort of hanging out there, that what could support the market in the second half, both here and abroad. But right now we're watching yields come down and by way of the 10-year Treasury. And as that happens, the U.S. dollar is also coming down as well, because Federal Reserve won't be supporting it after next week's meeting, we anticipate. In fact, the dollar's already been moving in that pattern in anticipation of that. So what's the opposite of that? Well, then you want to look at internationally. You want to look at emerging markets, which have been out of favor. But emerging markets seem to be catching a bid almost to the day. as soon as we saw sort of inflationary pressures sort of release and moderate here in the U.S. Again, we look at valuation basis, large cap growth over large cap value. You basically want to sort of, lighten up on large cap growth because they've had a 30% run year to date, and maybe look at some value stocks that are paying dividends, high quality balance sheets. If we do see a recession, they could work their way through and sort of be sort of a protection, if you will, for your portfolio as you gather that income and have that income build up. But also small caps, let's say we don't have a recession, small caps have very interesting valuations right now. Again, I'll go through that in my market intelligence report. We like energy and industrials and as well as financials for the second half of this year. We can go into greater detail on that as well. But overall, there's plenty of opportunity. There's always a bull market somewhere. This is a moment in time where you should be rebalancing a portfolio. If you're not, you should be taking advantage of sort of the undervalued, those that actually haven't participated, like the industrials year to date. They're starting to play catch up with large cap growth, as well as look at the yields. Okay, so in the fixed income market, we're seeing the most interesting and compelling opportunities where you want to lengthen out or increase the length of your maturities, simply because if interest rates do start sort of normalizing here, and then ultimately in 2024 coming down, which that the yield curve is presenting that's potentially the case in terms of Fed funds futures, why wouldn't you go later or longer on the yield curve, lock in today's rates, and sort of clipping those coupons, maintaining that cash flow at sort of higher yields today, what could be lower yields tomorrow. So there's a lot of portfolio position. Again, if you want a portfolio review and you're not our client, we're happy to do that as well. But more importantly, thanks for watching and subscribing, and we'll see you again next time. And we'll stay tuned for our market insights and observations for the second half playbook. And again, we're here for you if you need us. Take care.